From the morning reading. Good morning, traders. None of the three major U.S. stock market indices has broken above the respective all-time highs. However, the New York Stock Exchange Composite did this yesterday. This is a bullish indication for the market going forward. However, as we continue to see with our elevated risk levels, there is a number of very important flies in the ointment. The Dow Jones Industrial Average is close to hitting a multi-year high, while the transportation and utilities averages are more than 5% below their own highs. Such large divergences tended to lead to subpar performance, especially when excluding the mid-1990s. Yet again on Wednesday, two of the three indices that technicians watch for in Dow theory lagged the broad market. The Dow Jones Industrial Average is close, within 1% of a breakout from a multi-year high. The transportation average is more than 5% below its own high, and the utilities average is nearly 10% below its high. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:58 a.m. Central Time, and I'm recording this in preparation for the market day of April the 16th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see just what we have shaping up for this morning. Well, when you look at our own four broad market indices, there is some weakness, and indeed the ES is down about 0.5%, followed by the NASDAQ. The Dow's down about 0.36%, with the Russell holding up the best, and that certainly has been something of a story lately, with the small caps being pretty strong. In terms of perhaps the most significant move of the night, that would be crude oil, down 1.4%. So those of you who continue to think that this is about to break out and just keep running, it may. But you better be ready for a pretty volatile ride, because it has some pretty big swings going on, and a lot of these swings have been occurring in the overnight. And the euro, you have up 0.36%, bonds up 0.42%, and gold up about 0.5%. So quite a bit of movement in the overnight action on all 8 of the futures markets that we watch. So you should see some pretty significant gaps at the open today if this holds up. In China, wow, up 2.71%, big gap coming for FXI and other China ETFs, it would appear. Hong Kong up 0.44%, Japan up about scratch. Germany, though, Europe going a different direction. Germany down 1.56%, United Kingdom down about 0.4%. Okay, Thursday on the macroeconomic reports is usually a busy day, and it certainly is today. We have building permits, unemployment claims, the weekly version, housing starts, Philly Fed manufacturing after the market opens, as well as natural gas storage. You also have at least a couple members of the FOMC speaking later in the trading day. On Friday, we continue this action, and for the U.S., we have CPI and core CPI and preliminary University of Michigan consumer sentiment. That's that wild card one that happens in the middle of the trading day. So be aware of those events. As we get into volatility, let's see what's happening here. We have short-term volatility. Look at this, down to 10.59. Your implied volatility is also quite low, really in about the bottom quartile for all four broad market indices. We finally did have a standard deviation move yesterday, and that occurred in the small caps. We had more than a 1 standard deviation move in the Russell, but all the other markets remain relatively quiet. So this is it's kind of been interesting, because we go through about a 2 or 3 week period where like every day practically was a standard deviation move, and we were oscillating most of those times, up a standard deviation, then down a standard deviation, followed by up a standard deviation. A lot of movement, but not really accomplishing anything, not really going anywhere. Then we go into this period of super, super quiet, and the compression is kind of playing out in a number of different ways. As we challenge the all-time highs, though, it seems to be just crawling up very slowly, and yet at the same time methodically. So that is certainly a bullish stance that we need to pay attention to. And indeed, let's take a look at the daily report. Crude oil, I'll remind you about that. That futures contract's probably going to see its volume roll over here shortly. In fact, if you give me just a second, I'll take a look at the volume. We are still almost 2-to-1 with twice as much volume on the old contract versus the new contract. So you should still be trading on the K contract, crude oil traders, but very quickly that will move over. So stay on top of that. In terms of our market trend intermediate term phase opinion, we remain at phase 3. We are looking for higher highs and higher lows. Very important that we establish some higher highs and that we mark this intermediate term as a continuation pattern. But there are, as I mentioned at the beginning of the broadcast this morning, a number of warning signals in this most recent. This is certainly not a case of the all-out bull market all the time like we seem to experience so much in recent years. This one is definitely experiencing a lot more consternation about this movement. And if you look at the portfolio investor posture, the IBD status remains uptrend under pressure. GMI index of 5 out of 6. Our active trader market posture, though, is very bullish. I should say bullish. We haven't gone over an 80 yet. We'll take a look at that right now. We're close. At 80, I kind of think of this as very bullish. And certainly, we've had a number of days now in which we've maintained this bullish market posture, and it's across all 4 indices. The Russell is actually very bullish at a 91, so certainly initiation of new short-term and intermediate-term bullish trades would be okay. The question is position size, and indeed you have a little bit of a divergence here with our position sizing opinions. Nothing new here from recent days, but the long side portfolio exposure at 50% for investors and volatility for the active trader, that based opinion says up to 100%. So really a lot of this depends on where you're coming from, what your focus is, and what your type of trading is as to perhaps which side of that opinion you pay the most attention to. In terms of market timing, we did see a bit of weakness, especially into Tuesday. You had a bit of a dip there. Did see some bearishness going into tax day, but then now, tax day and beyond, we start to expect some bullishness. And indeed, the one-day outlook is slightly bullish. The 3-day outlook is bullish. So we would expect to move into OpX probably with a bias to the upside. From a hedge warning status, we continue to remain at hedge level 1, and so an elevated risk level, though not extreme by any measure. That would be 2 or 3. But this is driven by a number of factors. Certainly the IBD status is a big part of that. Our current market posture being healthy at a bullish is the reason it has dropped to a 1 amongst other factors. But you look at these volatility-based things, you've got that VIX daily squeeze is still present. You still have a relatively high count on distribution days. If indeed this drops to 4, we will take this warning down a notch, but it certainly is still there. We've had a pretty high count of distribution days throughout this entire run. We have on our risk aversion indicators, we still have a couple risk off. And in fact, I thought this first one was going to cross over, but actually it backed off yesterday and did not have a crossover, so it remains in a risk off status. Option income strategies opinion still the same. VIX is inside the acceptable window, but it's in that daily squeeze, so consider position size, consider the effect of increasing volatility and how that would impact your strategy. But it is okay to initiate option income strategies, and I certainly have several on myself right now. Covered call strategies: neutral, calling for a 2-to-1 distribution between in the money and out of the money strikes. I know one of the trades that I modeled in the room came off yesterday, and it was very thankfully a trade that had been set up with a combination of in the money and out of the money strikes. And when it was all said and done, that's where the profit for that trade came from. It was profitable, and it was profitable because I had used a combination of in the money and out of the money strikes. If I just bought stock, I would not have made money on the position. And it was definitely a very nice setup when it was first initiated some weeks ago. But recognizing where we were in the market and allowing for a distribution pattern that was in alignment with that current level of market tone allowed that trade to be profitable. So that was a beautiful example of just what this opinion can help with. Put selling: neutral, so acceptable to sell puts against a core portfolio of stocks that you are willing to own in the position size you are willing to own. I certainly have initiated a number of positions in recent days, but keeping very, very careful to maintaining a position size that, should this market which has struggled so much to actually exit its range, break down, that I would not be in trouble of any kind of margin calls or anything like that. I would just simply be allocating some of my cash into the holding of stocks in which I have sold puts against, in part as an option income strategy, but also in part to buy stocks that I'm willing to own at a discount. So that is in alignment with our current hedge level, as well as our current understanding of this market posture. So those things all coming together in a beautiful way. In terms of the point and figure, I should mention something interesting here today. And let me flip something over here for you to see. This is point and figure. We talk about point and figure usually on Monday, just to note various changes and so forth. But one of the things about point and figure is that a point and figure chart really helps you understand when you have trend reversals or breakouts. That's its primary purpose, at least from the way I use it. Other people maybe use it in different ways, but this is a point and figure on the New York Stock Exchange. The green X to the upper right shows today's upside breakout, and a point and figure buy signal takes place when the last X column of rising prices rises above the previous X column. So today's upside breakout in the New York Stock Exchange exceeded 4 previous X columns at 11,100, which is a very strong signal. And so the X column represents rising prices. The O column shows falling prices. The main advantage of a point and figure chart is that it provides a more precise buy and sell signal. So I thought that was worth sharing as an example of why we include this as a component of the daily report. It does help us understand when we have something, of significance from a trend. And that's obviously, it's best to trade with the trend at your back, and you'll get greater follow-through and much healthier profit factor from those kinds of experiences. And that was worth noting. That is certainly a bullish mark on the overall market. Now, none of the broad market indices have actually done that yet, but they're getting close. And certainly the fact that the New York Stock Exchange Group did is telling. From a sector market posture, percent change, you see and it looks like I grabbed something wrong here. Here's our percent change. Obviously energy, big update yesterday. Remember in the overnight, we were talking about how energy is down so much that it continues to just have the heck of a ride. Now if you're a very, very nimble trader, that is a beautiful trading opportunity. But I would certainly point to You better have your wits about you and be able to trade that market, because it will whipsaw you back and forth in a hurry right now. But other markets were also strong yesterday. Really, the only one that was down was consumer staples, and frankly, consumer staples is probably the most consistent performer as a sector going on right now. And that was the one that kind of gave up some money yesterday as people were pouring money into some of these opportunities, as it were, and their expectations from that. And from industry group analysis, let's wrap up here. Retail, internet, healthcare, railroads, biotech into the top 5 are the top industry groups at this time, using the shadow trader method. Of course, if you like and are benefiting from what you are hearing here, we greatly appreciate in return that you invest in us and show your appreciation by liking us on YouTube, and as well sharing this resource with your fellow traders through social media and other communications. It is most welcome. And then additional information can be found at the website as always. Disclaimers. Hit the pause button if you need more time to review this. And then we will see you back here tomorrow morning at our market preview. Good trading.